Hey guys, welcome to the Apartment Investing Journey. I'm David Robinson. I'm here with my co-host, Mr. Dane Hill. Dane, how you doing today?
I'm doing great.
Good, good. So I'm excited about our guest today. He has a significant background in the commercial lending side of the business with a specialty in multifamily. And so I'm excited to introduce Paul Winterowd. Welcome to the show, Paul.
Hey, great to be here. Excited to spend a few minutes with you guys.
Yeah, we appreciate you coming on. I know you're busy, and thanks for sharing your time and your expertise. A little bit about Paul. Paul is a loan officer at Bonneville Multifamily Capital, where he has originated over $100 million in multifamily mortgages. He's also an active multifamily investor himself, both actively as a syndication sponsor and passive investor, currently involved in over 200 doors. Paul has been a featured guest on several other podcasts, including the Real Estate Guys radio show. Love that show. He's also been published in the Rental Housing Journal and authored over 50 blog posts on the Bonneville Multifamily Capital website. And from what I also understand, you're just an okay golfer as well. Is that correct?
I used to be good, but I'm okay now.
Well, Paul, if you don't mind, maybe just take a minute and tell us a little bit more about yourself, just so that we can get to know you and your story a little bit better.
Yeah, born and raised in Salt Lake City, Utah. Always had an interest in real estate, but as you alluded to, golf was a big part of my life. In high school and college, I played collegiately, which was a lot of fun. I was a mediocre college golfer on a mediocre team, but
I doubt that.
It was fun to play at the Division I level, and compete there. And it's stayed a passion of mine as well. I'm not real competitive in the tournament scene, but I do have a life goal that I'm working on of playing 500 different golf courses. So,
and where are you at?
I'm at 263 right
Woo!
now. So who's counting? So, but that's what I like to do in the spare time and try to get out and experience some new courses. But as I mentioned, I always had an interest in real estate, dabbled, I would say, in the residential space for a few years amongst some other things, and didn't really stick or resonate with me. But as I learned and progressed and started investing myself and building my portfolio, really had a strong interest in the commercial space, specifically multifamily, and feel fortunate to be where I am. Certainly, I have a lot of opportunities, a front row seat to see a lot of deals, and as an investor, I figured underwriting deals and figuring out what works on the debt side is a great way to understand what sort of deals are good to invest in myself. And so active in both sides of the business, but the day job as far as originating loans for clients is very much a priority in the bulk of my time.
So you mentioned that you started out investing in single family on the residential side type stuff. Tell us, how did you get into the lending business? How did you get into the commercial lending business?
Yeah. I chuckle a lot of selling and begging and praying, I guess, would be the answer. Had a connection, a friend that is one of our main underwriters here at Bonneville, and had an interest, and really it was flat persistence. The interviewing process was over 6 months, and just kind of stayed after it. I identified, hey, this is what I want to do, and just basically stayed at it until they gave me a chance, and
until they finally gave in.
It's worked out pretty well so far. So,
well, that's great. Well, if it's okay with you, let's dive right in. To start things off, let's just start with the basics here, and if you can, help us to understand the differences between commercial multifamily lending and the residential multifamily lending, like your duplex, triplex, fourplex. Help us understand the differences between the two.
Sure. That, just like you said, the line for residential is 4 units and below. So once you have 5 units, that's when it triggers a commercial loan. So 5 units and above in apartments is going to be a commercial loan. Now that isn't to say you couldn't do a commercial loan on a duplex or triplex if you wanted to, but the residential lending parameters, I think for those types of deals are more favorable, and it makes more sense to do that. On your residential, obviously you're looking at a standard 30-year term and amortization. So when you step into the commercial space, that does start changing a little bit. The natural progression for investors is to first secure debt from banks, local banks and credit unions, someone they may have an existing relationship with. And typical bank terms on a stabilized multifamily property are going to be a 25-year amortization instead of a 30. It's not to say there aren't exceptions, but that's by and large the standard in the market. And then typically looking at a 5-year fixed term. So there will be either a balloon payment or more commonly a rate reset at that 5-year mark. So you're locking in your interest rate for 5 years. And then at the 5-year mark, they're going to look at the market and say, well, it may be better, it may be worse, and it adjusts. And so the term and the AM difference is in residential, it's essentially one and the same, so you don't really differentiate. But in the commercial space, that's one of the first things you want to pay attention to. As far as constraints of the loan amount, there's really 2 common constraints. One that everyone fixates on, and then one in the marketplace that really dictates the loan amount. So it's good to be aware of both. The obvious one is loan to value. Again, in that bank space, the common loan to value is a 75% loan to value or purchase price if you are acquiring a property. Now, the second constraint, and it's always the lower of the 2, is a debt coverage ratio. And your debt coverage ratio, the standard in banking is 1.25. And you simply calculate that by taking your net operating income and dividing it by your annual principal and interest payments. And so the bank wants to say, hey, we want you to pay us 100%. We want to make sure that you're making 125% of what we require to get paid back. And that, I mean, we're in business to make money. That's essentially your profit. So that's the common constraint. And with where we are in the marketplace and values being high and cap rates lower, that's the common constraint. I would say 9 out of 10 deals I'm looking at are constrained by debt coverage. And it doesn't mean the loan can't be done. It just may mean that levers back to maybe 70 or 65% to do the deal. So you need more down.
Great. Those are some great distinctions between the two. Walk us through, if you can, the commercial multifamily lending process. Let's say that we have an investor and they've identified their very first commercial apartment building that they want to purchase. Maybe they've had some experience in the residential multifamily, but this is their first commercial multifamily apartment building that they're looking to acquire. Walk us through the process on the commercial lending side.
Yeah, several things I want to key in on, and just to frame it, debt is so ubiquitous, right? There's so much debt out there in the marketplace, and we're so used to debt on real estate. People will come to me, and even experienced investors, that, hey, I just deserve debt. I just deserve a loan, or I should have it just because everyone else gets it. Well, there is a process, like you said, and there is underwriting, both on a personal or sponsor basis, and then also on the property. So a lot of people come and say, hey, I got this property. What can you do for me? What's my rate going to be? And as we all know, and it depends, right? There's a lot we've got to look at. From a credit standpoint, here's some general parameters. Every lender has some differences, but this is, if you follow these standards and metrics, you're going to qualify for the vast majority of loans. The first, you want to have a credit score that's at least 650, preferably 680 and above. These loans, the nice thing about commercial loans is they don't show up on your personal credit report. the borrower has to be a single asset entity, which is typically an LLC. So it's not in your personal name, it's in the name of a business. Whereas in residential, again, a distinction, it's in your name. You can't even borrow using an LLC. You have to borrow under your name and put it in an LLC. In residential. Commercial, it's the opposite. You have to borrow in an entity. So credit score and then net worth. A good metric is net worth equal to the loan amount. So if you want $1 million loan, they want to see $1 million net worth. That can be combined. That can be daunting for people starting out. And so that's why it's very common that we see partners. There may be a boots on the street and then a more passive money guy they're both signing on the loan to hit that parameter.
And could that be both a joint venture, but it could also be a syndication with the general partnership? Great.
Yeah, lots of ways to skin this cat.
Okay.
And then the liquidity, that's cash on hand after your down payment, it varies between 5 and 10%. I like to tell people a great metric as a real estate investor is to have 10% of your net worth in cash. Stock, it could be equities or just cash. I think that's conservative, but everyone wants to deploy their money and get a return, but you do need some of that money on the sideline to qualify for loans. So those are some of the standards. So it's great when you're coming to me, to have your personal financial statement, your schedule of real estate already put together and updated. So rather than me saying, hey, here's a template, go track this down, you can come ready to go and we can quickly check that box. It's a very quick process.
So I've got credit score minimum of 650, your net worth ratio of 1 to 1 for the required loan amount, and cash on hand. Did you say 5 to 10%?
Correct.
Okay.
Correct.
Great. Is there anything else as far as the basic underwriting criteria that a buyer needs to know right out of the gates before they even think about coming to you to get a loan?
Yeah, so that's on the sponsor or guarantor side. Experience always helps. That's this whole side conversation, but it's easier to get loans if you've done it before. But everyone has to start somewhere. So whether you're partnering or that sort of thing, and different loans require different experience, but that's the only other thing as far as a credit standpoint. Now the property, once you've checked that box, the property has to qualify as well. So what we're looking for right out of the gates, it's pretty simple: a current rent roll and a current trailing 12 operating statement or a profit and loss statement showing all collections, rents, and expenses. You'd be surprised how many times that is very hard to get. There's a lot of,
or have it be up to date and accurate.
Yeah, there's a lot of unsophisticated owners. Again, I don't say that disparagingly, but there's for a lot of different reasons, people may be tired and that's why they're moving on. They're not necessarily, but we can work through that. But a sophisticated seller certainly is going to have that information readily available, and that's what we need to start the process. It always helps to have pictures of the property. Obviously, we need an address and some idea around your strategy, what you're going to do. Is this a buy and hold? Are you hanging on to this for 10 years? Are you going in? Are you adding value? Are you going to be rehabbing? Are you in it for 2 years? There's a lot of different loan structures. So understanding that strategy or hold period is really helpful to structure the loan and get you to the right program to suit your needs. And then this is often overlooked, but immensely helpful to lenders and also to help you as an investor determine whether this makes sense. But build your pro forma. Take the 2, 3, 4 hours that it takes. Put together your pro forma of how this is going to operate for you, where you think rents will be, where you think expenses will be. It's impossible not to learn a lot about the property by underwriting and building a pro forma. And that can help you make decisions, because ultimately everyone wants everything. right? But there's different levers when it comes to the loan, like longer terms, maybe a higher rate, or a softer prepayment schedule may increase your rate a little bit. Everyone wants the most loan amount, the lowest rate, the least painful prepayment penalty, but there's levers as far as what you can get. And so having your pro forma can help you make that decision. Oh, if I want this, I can plug in this number and it produces this IRR and this equity multiple. But if you don't have that, I'm coming back to saying, here's our loan quote. And you're like, well, I don't know, or maybe not. But if you have that pro forma built, you can plug in that number and be like, yeah, 16% IRR is great. I'm in, this works.
That's great. So on the borrower side, we've talked about that and your key underwriting criteria there. On the property side, they need to produce or obtain an accurate T12. Mm-hmm. Pictures are always helpful. Putting the business plan together and being clear on what your business plan is, and exit strategy. And then also doing your own upfront underwriting and having a pro forma ready for you. Is there anything else that a borrower that's coming to you for their first commercial deal that they would need to provide that would be helpful to the process?
A couple other things that underwriters always key in on when we're vetting for viability of the loan. One is certainly occupancy. So how many bodies are in there? And that's your physical occupancy, or the opposite's that, your vacancy number. But the economic vacancy is actually more important. So you may, out of a 20-unit building, you may have 1 or 2 vacancies, but if collections are really poor or people are behind, you may have an economic vacancy of 20 or 25%. That's going to hurt us. That may mean you're not going to qualify for some of the best programs out there.
What's your ideal percentage?
We have to underwrite to a 5% vacancy. So if you're 100% full, we're going to carve off 5% vacancy through underwriting. But if you're at let's say you're at that economic vacancy or collections, and another way to look at it, if you're at 20% vacancy, that might preclude you from doing certain loan programs, or maybe you need to do a bridge loan to acquire the property and get it stabilized to that. At least 90% is what we really need in order to do your mainstream permanent loans. Now, again, that doesn't always fit in every box, and that's why there's bridge loans or construction loans to transition. But
your long-term debt programs, you're going to need to be about 90% economic occupancy.
Correct.
Great.
Correct. And you underwrite to the lower of. Again, if you are at 92%, then that's what we'll underwrite to.
Gotcha.
Spreading the loan.
Okay. This is great. So any other key underwriting criteria that we should be aware of?
Well, there's a handful, but I think by and large, that's the core things that you need to pay attention to. There's of course an appraisal. Your property is going to be subject to an appraisal. In our market and landscape, that's rare. That's problematic. If we're talking 2009 or 10, it may be a different story, but right now properties are appraising, so that's not a problem. There's going to be a physical inspection. Just make sure that it isn't scorched earth sort of property. It's viable, it's safe for tenants. And then the legal side can be definitely more complex than residential. There's not a whole lot of legal involved in residential deals, but lenders will have their legal teams review. And then as you're getting into the syndication space, that legal side from a borrower standpoint can get complicated. That has to be reviewed by the lender, and you're going to spend some money with lawyers, but it's well worth it to make sure you're complying and the SEC doesn't hunt you down and throw you in jail or something like that. So,
right.
But that's that's more down the road. That's not, those are boxes that need to be checked more so than what you need to really plan and prepare for on the front end.
That's excellent. Thank you for walking us through that. That's very helpful. If you can, maybe take a minute, and you've been doing this for quite some time. You have lent on $100 million in commercial loans. What's if you could describe for me the profile of your typical or most common borrower? What do you see, and who do you work with most commonly?
It's a tough question to say most common. I'd say there's maybe 2 or 3 buckets of individuals that I typically work with. Easiest perhaps to wrap your head around is what I call the lone wolf. They've typically been in real estate, or they've been successful in business, and they need a place to park their money. They don't really like partners or want to work with partners. They do their own thing. They're putting up their own capital as the down payments and running their show, content to grow at a slower pace. They're in it for the cash flow type thing. That's the lone wolf. The second bucket of investors that I work with are the syndicators. Again, they're out, they're beating the streets, they're sourcing the deal, coming up with the business plan, putting together the investors, and then doing the deal. If you're starting out, it's a great way to do it. The key there is having someone that can qualify for the loan. You can syndicate a deal with very little of your own net worth or liquidity, but you need someone that's going to sign on the loan with you. So having an experienced investor come along, that's fine. And experienced, sophisticated investors, I know from experience, sometimes they don't want to be in the trenches, but they want to be in the deals, right?
Sure.
So it's just the life cycle of how things work. And then the third bucket of investors that we work with, I would say, are really in that development realm. So it's the new construction. They're finding land. They're working through the whole entitlement and permitting process and going vertical. So they're from the ground up, really, is what they're doing. Just
great.
A developer.
Great. So those are your most typical 3 buckets, the type of borrowers that come to you for their lending. Dane, I want to give you a chance to jump in here. I know you have a few questions for you. What questions do you have for Paul?
Well, the first one I wanted to ask, and this kind of goes back to what we were talking about a little bit earlier, but on someone who's working in kind of the value add space where they're going for these distressed properties or properties that haven't been managed well, that probably have lower occupancy and have some stuff that really needs to be done to them to get them up to a livable standard. Like, what are some hurdles and what are some loan types that those kinds of people can pursue to be able to close on these buildings?
Value add. No one's interested in value add these days, right?
That's the hot topic, right?
Everyone loves value add, of course. In fact, I got an email yesterday from a contact of mine, said, "Hey, if you ever see any value add deals, let me know." I'm like, yeah, I wish I had those to dish out, but they are out there. Certainly it's a very, there's a lot of interest in that space. That's the majority of what syndicators are looking for. That's how that works. And so the absolute best way to do it from a return maximization standpoint is really a 2-step process. Now, it does introduce some risk, and it's not for everyone per se, but to minimize your cash into the deal, you really want to do a construction or a bridge loan. The cheapest money is going to be working with a local bank or credit union and getting a construction loan. Sometimes for beginners, that doesn't make sense. It's already built. I don't need a construction loan. Well, you are putting a lot of money in rehab into it. And so getting a construction loan to acquire the property and then include some of the repairs makes a whole lot of sense. Let me take a step deeper and explain why. On a permanent loan, we have to underwrite to what the property is, how it's performing, what's being collected. And that's inevitably going to constrain our loan amount because we're going to have that debt coverage constraint. So we're looking at 55, 60% loan to value. And everyone's like, I got to do that. I got to put 40% down, and then I got to have my whole budget. Well, it doesn't work. On a construction loan, typical norms, and again, in the Utah market, different markets may vary a little bit, but it's 75% loan to cost. So you can take your purchase price plus your rehab budget. So let's say you're buying it for $4 million. You're going to put $1 million into it. Your total cost is $5 million. So then you do a 25% loan to value on that, rather than, so you're bringing in what, $1.25 million, rather than maybe $2 or $3 million. So you got to get after it at that point. Your construction loan typically is going to be a year, maybe 18 months. And so you got to get after it, rehab it, get it released, stabilized, and then come in with a permanent takeout loan where a common constraint is about 90% of cost on your permanent takeout loan. But we have done deals where we've got up to that 100%. Again, there's debt coverage constraints in today's markets for value. The fantasy is, hey, I'm going to get all my money out. That's rare. That's more the exception than the norm. We certainly like to see about 10%. We like to see some skin in the game on that takeout. But again, when you're looking at 10% of your costs in the deal, that's pretty good leverage, and that's really the best way to maximize returns. Now there's an added element of risk because the construction loan can be recourse, and you don't know exactly what your perm will look like, but that's a go-to strategy that I'll work with on my clients on value add.
Great.
Follow-up question on that. What's the minimum loan that you focus on, or that these programs, what's the minimum amount that they could borrow?
So there's a couple different buckets here of money. Refer to them as the primary and secondary market. The primary market is your banks and credit unions. So that's about half of all the loans funded are coming from those sources, from your Granite Credit Union to your Wells Fargo, anywhere in that realm. Those are typically recourse loans, meaning you're signing an unlimited personal guarantee. So if the property goes sideways, it's foreclosed upon, the bank can come after you personally. Your home, your car, your other investments are at risk, so they're made whole. The second bucket, or the secondary market, is this non-recourse space. That's where we get into Fannie Mae, Freddie Mac, HUD, CMBS, insurance companies. So that's in the non-recourse space, and that means just the property is the collateral. If you were to go sideways, you wouldn't have an unlimited personal guarantee. So banks and credit unions will go down to maybe 500,000 would be a minimum. It's hard to say, there aren't exceptions, but that's a pretty common standard. In that secondary market, it's $1 million loan amount, but you are limited as far as some of the programs. You're basically open to all the options when you're getting above the $5 million loan mark. So there's different levels, but there's different programs that cater to everyone, and that's really my job. As far as I work with lots of different sources of capital, lenders, understand what they have an appetite for, what can get done. So when a client comes to me, I can really put them in the right place.
And my understanding is that is a specialty of yours in the non-recourse Fannie Freddie. But what I'm hearing you say is that you can also work with the other recourse loans that are out there.
Definitely.
Okay.
Yeah, it's good to have options and cover your bases. So
great. All right, Dane. Any other questions you have for Paul?
I guess the last one I had was if you are looking at working with a commercial mortgage broker, lender, what are some things that kind of set a really good lender apart versus kind of a mediocre one? I guess like some good things to look for when you're looking to kind of establish a relationship with a lender.
Yeah. Um, I'll answer that in a couple different ways. If someone wants to go, if they're just getting started in the business, I wouldn't be afraid of saying, hey, go out and talk to a bunch of different banks. See what that's like, understand what the market is, get smart talking to a handful of different banks to understand that and just get your feet wet. One analogy I'll use is you can get on Google and type in commercial mortgages. Well, the ones that pop up are the best marketers. They're not necessarily the best lenders per se. So it comes from a lot of time and experience and conversations with different lenders. And again, that's my focus, or a commercial mortgage broker's focus, is really understanding not only the programs, but who can get stuff done. You could walk into the exact same bank and you could talk to two different loan officers and get a very dramatically different result as far as getting your deal done. Now that doesn't make any sense. It's the same bank. Wouldn't they have the same criteria and look at things the same way? It's just not the case. Time and time again, I've experienced that. And it's not that anyone doesn't try, but just some people have greater ability to put together a deal and get it through ultimately loan committee. Every loan's got to go through a committee where a bunch of unnamed people are looking at the deal saying yes or no. And so working with the right people that know how to get that done is crucial. So I think coming back to your question, certainly you want someone that has a lot of resources, that has experience, but what's coming to mind is something that Dave Ramsey, if you're familiar with who he is. I agree with a lot of what he says. I don't agree with what he says about debt. And for investment properties, obviously, if you know much about him, I think it's a pretty unsophisticated approach on that sort of thing. That's an aside, but having that heart of a teacher, working with someone that's willing to take some time and educate you and work with you and help you through the process, especially starting out, that's going to be important. All I have in this business is my time. Like, I'm not making money if I'm not doing deals. I've got to put food on the table. So I have an incentive to get that loan closed. But that's a huge advantage of working with the mortgage broker, is because you have someone that knows the lender, knows them intimately, and has some pull and has some reason to take business back to them. Well, if you're just walking in off the street, they can turn you down and no big deal. If they turn down a client that I bring to them, they might rub me the wrong way and I might not take any more deals to them. So not only do they want to maintain the relationship with me, but I can also be an advocate and fight for the deal as well. And so those are some nuances. I feel like I've rambled a little bit, but
no, that's great. That's great. Well, look, Paul, you've been gracious with your time, and we need to start winding down here, but just a couple rapid fire questions for you. So dirt reaction. Here we go. You ready?
Yeah.
All right. What's the biggest mistake, and this could be in your own personal investing or on the lending side, what's the biggest mistake you've made during your apartment investing journey?
Waiting to get in the game. Should have started way sooner.
Cool. What's the best win you've had on your apartment investing journey so far?
The biggest win thus far has been a reposition. It was a big value add play. It was in the avenues of Salt Lake City, but we had investors in the deal. Investors saw a 2.2x return in just under 20 months. I saw a return beyond that. It was a huge win. A lot of work, a lot of effort, a lot of hurdles, but financially very, very rewarding.
We might have to have you on another time to talk about that one.
We could fill up a half hour, no problem.
I bet. And lastly, what's the best advice you have for someone who's just starting their apartment investing journey?
Don't be afraid to take a chance, take a risk. I've worked with a lot of people that want to get in the game, that have an interest in this, that are on the sidelines. I have clients that are arguably and admittedly less sophisticated, but they're doers. They're willing to jump in. You learn so much by doing. If you did a deal and you lost 30,000, you're going to learn so much more than spending 30,000 on an infomercial or some guru. Not that there aren't great value in some of the gurus out there, but getting in the game you'll learn so much by actually doing it. Don't worry about making any money on your first deal. Look at it as education. Just get in the game.
Awesome. Well, Paul, you've been very gracious. We appreciate your knowledge, your expertise, and you taking the time to share with us today. How can the listeners get in contact with you in the future?
Probably easiest is to send me an email. My email address is paul@bmfcap.com. paul@bmfcap.com. I'm on there quite a bit. I can add you to my newsletter from there. If you have any questions, reach out. We can set up a few minutes to chat.
Great. And we'll make sure that's in the show notes as well. Well, Paul, thanks for your time. Hope you have a great day. We'll talk to you soon.
My pleasure. It's been great. Thanks, guys.
Thanks, Paul.